Hi, I'm Peter Rose, founder of Longwood Currency Trading. How do you manage unexpected Forex price action moves? What is an unexpected Forex price action move? Well, let me give you an example from real life. And that was unexpected. It's March of 2025, late March, and we had a severe windstorm, and it was 55-mile-an-hour gusts. And this is what happened. At a small tree here, I'm out by the wood pile. You can see there's not much wood left. We had wood stacked up in here and all around. Let me spin around and get back to our fallen tree, which is the unexpected event. How do you deal with that? Well, I don't have a chainsaw, but I have friends that do. And so they'll come over and cut it up, stack the wood, and I'll burn it next year in the wood stove. That's how I dealt with an unexpected physical event in nature around me. And trading, is that any different? Look, if you've been trading for any amount of time at all, you've got caught, right? You've been in a position, it's moving in your direction, and then all of a sudden, it just decomposes so quick. It's like shit through a goose, and the result is usually a loss. What are you thinking? What's in your head when that occurs? We had back to nature here. We had 14 inches of snow in the yard here, and you can see it's starting to melt, starting to go away. This pile of snow here along the side of the house, that was 5.5 feet tall, and now it's down lower. What am I talking about? I'm talking about change. Let's talk about change. Okay, it's a little warmer in here. Little coffee. So unexpected events really is a subset of a term that we call change. I have a tree that goes down. That's an unexpected event. It's a change in the disposition of the tree, the state of the tree. And the difference between maybe a tree falling and how I'm going to mitigate that time differential of execution of that whole scene is far more condensed within price action. So if you don't really understand trading, I guess, and this is what I find in talking with people, people are trying to learn Forex, but they don't understand trading. And you really need to, well, Peter, what's trading? This isn't a video about trading, definition, but when you are in the Forex market, you have this thing called price action, and that moves. If it didn't move, you wouldn't have a differential in your opening bid ask or your exit. You wouldn't have a difference in that price. You wouldn't make any money, right? So you need the price to change. That change can be gradual. I mean, I could have had that tree out there going like this and gradual. It didn't exhibit any of those signs as I was out there stacking wood and pulling wood off and all that for the last 8 years. And yet, a severe windstorm and boom, an unexpected event. We're trading Forex. We're expecting things to change. I mean, that tree out there, its leaves changed, the branches would fall off in a storm or get blown off, and so it's state change. But the price action we expect in Forex to change on a minute-by-minute basis. And so if you're looking for your price to go, you're a day trader, right? We're down on a 5-minute chart with an ATR of, let's say, 5 pips. We're expecting within the 2-hour time frame that we have available to us to do our entry analysis and then manage positions and all this stuff. We take a couple of 3 trades in a couple hour period of time. And so we're looking for 5 to 20 pips of profit. Maybe we're going to chatter through it, a couple of trades, two fives to get a 10, or we're shooting at a 20 and we get a 10 or 12. It's a change in price that's going to enable us to do that. What's the difference then when you have, quote, an unexpected price action move? Is it unexpected, or is it simply a larger change than you had been hoping for so that price would go long enough in the direction that you wanted it to go in so you could grab your 8 or 25 pips or whatever it is that your profit target is? It would have been great to have a pin bar and it hits your profit target and you're out and then back it slides. That's fine. But what happens when that price action goes negative against you? And we're just talking about going long here. It can work the same way if you're short. Did you know that in 4 minutes, the non-farm payroll was going to come out? And you're sitting there without any knowledge of that, and all of a sudden, price goes 40 pips against you in about 20 seconds. That's an unexpected Forex price action move. Well, who was it unexpected by? You. Price is going to change one way or the other. You're just hoping that price is going to continue to move in the logical, normal, momentum price action direction that it was going in, so you could grab your 12 pips and go to work. You have to understand the market has nothing to do with you. It doesn't care about what your hope, fear, or greed is. Did you know that the non-farm payroll is coming out? Did you know that it was going to be within 3 minutes? Did you know that within 3 minutes of a non-farm payroll, the big money is starting to position and take sides, actually taking the opposite side of where they know from a probabilistic standpoint that the price is going to go, so that the whipsaw is going to be really violent and they're on the trigger. And who are they selling to? They're selling to you. Now, we don't account for much as retail traders in the $6.7 trillion a day Forex market. It's the big institutional traders that control all that. But why don't they take advantage of us? We may be, I don't know what we are as retail traders. When I started looking at Forex back in 2007, 2010, I think, let's see, it was, 2008 or something like that. It was about a $3.4 or $4 trillion a day market, and then it gradually increased. And back in the last statistic I had was a few years ago, and it was 6.7 trillion. I don't know what it is now. But back when it was $4 trillion a day, the retail traders constituted about 15% of that market. I doubt very seriously at 6.7 trillion that the retail market is 15%. You get institutions that can come up with that money, and you can have other countries that are having a higher production of goods that are going to be exchanged to cause that daily volume to go from 4 trillion to 6.7 trillion. But I don't think that you're going to have us as retail traders correspondingly more retail traders and more retail traders with more money to be able to keep up with a 15% of a $6.7 trillion a day market. I'd hazard a guess to say maybe we're 5% of that. And we've lost a lot of retail traders to the crypto market because everybody failed in the Forex market because they didn't know what the Forex market was. They were trying to bring stock market analysis tools to Forex. They had a bunch of idiots that were teaching you, and it was just a cluster. I mean, I've had people comment on my videos, oh, Forex is a scam. And oh man, there's so many ignorant people in the world. Hopefully you're not one of them. You realize the value of the Forex market, and it's not going to go anywhere. It's constantly going to be there. It isn't going to constantly go up. It has to go down, because if you go back 20 years, you're going to see that Forex has traded within 2,000 or 3,000 pip range. Now, sometimes it'll go up. In the last month, price has gone up, I think 800 pips from where it was at a swing point at the bottom. So the price moves in a direction for a long period of time, but eventually, because of the factors involved in what constitutes the Forex market, what does that order flow need to do? Why is the market there? It's not going to continue to go 800 pips and 1,600 pips up and 2,800 pips and 10,000 pips. It isn't going to do that. Why? The reasons for that. And so when do you know that that's going to change? And if you're looking at a price action, it's squiggle lines, right, that goes up, but it goes up for 700 or 800 pips, and then it'll gradually turn over. You might get a blow off and a spike down of a couple of hundred pips or whatever, but then it'll go down, and you'll have this move up and down. That's a change. It's like the waves on the ocean. I think it's 400,000 waves, you get one that's 4 times the mean height. So if your mean height is 2-foot waves, you're going to get an 8-foot wave in there. And sometimes you get a rogue wave, 50 feet or something like that. So it's the same thing in the Forex price action. Sometimes you'll get a 10 pip move, and sometimes you'll get a 200 pip move in the same period of time. So it isn't that it's an unexpected price action move. It's unexpected to you if you don't understand price action itself. And price action is a subset of trading, because if there was no trading, there wouldn't be any price action. What I'm trying to foster in you in this video is to look at Forex price action differently and not blame the market for what you're going to term an unexpected price action move, which is 3 times the mean, or 2 times the mean, or 10 times the mean. It's not unexpected. It's a change that's larger than what was normally there. It's just that because you didn't know that there was an on-farm payroll event, or a PPI, or that some country is going into major political elections and that was going to affect the commercial viability of that country's goods and products for international exchange and trade. If you don't know these things, if you're not aware of the world around you, how can you possibly not get caught by unexpected price moves? Understand that all price action represents is a change in the needs of industrial institutional clients putting orders into the large house traders so that they can conduct international commerce. That's what it's all about. It's not based on hope, fear, and greed like the crypto market or penny stocks or whatever. It's based on economic conditions. Do you need to be an economist in order to judge this stuff? No, you just need to know when the non-farm payroll report is going to come out, or when it's not in a period of time where you can expect the kind of price action moves that it's going to get you to 20 pips in an hour that you need to have it move in order for you to go to work. The market doesn't care about that. And once we understand that, once we understand that the market doesn't give a shit about us, it's not price hunting us, it's not stop hunting us, it doesn't care. Your 2-lot order, 5-lot order, 100-lot order is shit dust in $6.7 trillion. It doesn't matter. Well, if you're getting up to 100 lots, which is the max on a lot of the retail brokerage platforms, they limit that because they're holding the order until the end of the day when they can flush it out into the interbank market, because they're not big enough to do it to trade in the interbank market. So if you get a lot of retail traders all going in the wrong direction at the wrong time, that broker is going to get very hurt if they don't stop everybody out. But that's rare. You know, the Swiss financial crisis was an example of that happening. And 95% of the brokers went bust and their clients lost all their money because of the size of the retail market that was uninformed, and that these price action moves were unexpected, and the concept of risk management was ill-placed because they didn't understand the purpose of the Forex market to establish the correct risk management principles. They were basing their trading on trend trading out of the stock market. And that's fine, but within the constraints of price action as you find it within the Forex market itself. And so how do you manage unexpected Forex price action moves? You don't manage them. You have to anticipate them by understanding that an unexpected move is the same as an expected move. It just might be that the magnitude of that move is larger than you might expect, and it's probably 80% against you that you're going to pick the correct direction. Because if you don't understand the Forex market, you won't understand the potential for an adverse market price change. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.